Davis, thanks for joining us.
Well, I appreciate you having me.
Yeah. So would you just tell us briefly who you are and what you do and who you do it for?
Yeah, absolutely. So my name's Davis Orbach, and I'm a mortgage banker, and I do it for Cross Country Mortgage. So Cross Country Mortgage is a top 5 lender in the country, and I've been doing it for a while.
That's awesome.
I actually have had 2 careers. Started this North Carolina career in 2010.
Yep.
So
Awesome.
they're both about, I guess I'm coming on 14 years or 13 years. And the first one was 14 years.
Well, good. Well, I thought a good way to frame the conversation would be to go back to that previous career and kind of talk about, oftentimes we're seeing a parallel being made of the market in the last 2 years to the lead up to 2008, 2009. And I was wondering if you could help explain some of the differences that you have seen on the mortgage side that is different today than it was in the years leading up to the great financial crisis.
Yeah, I think I could probably shed some light on it. I actually got out of the mortgage business in the DC area in 2004. However, I stayed connected with it, and I was on the building side. So I kind of saw it from that lens as well. Well, the big difference is what happened back then is in the early 2000s, so there was a census that suggested we needed to open up the guidelines a little bit. Fannie Mae and Freddie Mac came out with alt-doc back then. I don't know if you remember.
What's that?
Alternate documentation it allowed you to streamline the loan process. So it became not as strict on the underwriting side. And that kind of started this whole process of, then in the 2002, 2003 timeframe, you started seeing the ability to do 95% loans up to like 800, 900,000, and you could do first trust, second trust. And a lot of times the first trust could be on interest-only ARMs. And, the idea back then was you could find, property is going to always go up. So you just finance as much as you can.
Right.
And as time went on, 2003, 2004, we started seeing those become 100% loans. So it was an 80% first trust, a 20% second trust, and then the documentation started getting less and less. Back then, there was products that were, they performed very well, but they were stated income, stated asset programs. When they first started, and most through the 90s, they were great loans, and they performed very well because it was, pretty strict, 20% down, 25% down, and you had to have good credit, and you had to have all these asset reserves. And what happened in 2004, 2005 is not only were we doing these interest-only ARMs, but we were doing them based on stated income, stated assets, and it started out in that time frame to be where there were still pretty strict credit requirements, and then it became.
What's an ARM before you go on?
It's an adjustable rate mortgage. So if it's a 30-year loan, but it's fixed for a set time, like a 5-year loan would be set for 30, it's amortized over 30 years, but it's set for 5 years at a discounted rate. And then at the end of the 5th year, it becomes adjustable. So that's when it gets scary. And then a lot of people were on interest-only payments. And a lot of those programs became fully amortized after 10 years. So it was setting up for, craziness. And then the stated income and stated asset programs the credit requirements became all to the point where there's no real credit requirements. So almost anybody could buy a home and it didn't matter the limit. And it really got that crazy.
Yeah.
And the difference now is that, back then it became Wild Wild West, and this time I would say regulation changed drastically in 2008, 2009, 2010 timeframe, and it hasn't gotten any less regulated. So we are not going to have the same type of housing situation due to, loans getting, out of control. So
yeah.
Might be other reasons.
Yeah, we can talk about that. So when you say that regulation, what does that mean for most borrowers or consumers? What does that mean to them on their end?
Well, it's really the supporting documentation, the requirements up front. How it's all about qualified mortgage, right? That we've got to be able to provide proof that they can carry the payment. So, there is no stated income or stated assets anymore.
We have to prove it.
Yeah. It's all about proving it now. So,
right.
Yeah.
Got it. Okay. Well, good. Well, I wanted to kind of talk about the impact of 2020 and 2021 and 2022 on your business. So if we could kind of start in 2019, where the market was leading into COVID, and then obviously we had COVID and there was a brief lull, and then it kind of went crazy. So if you could kind of just walk us through those few years and the impacts that it had on you and your business, and the mortgage business in general.
Yeah, I mean, in 2019, I mean, I think for leading up to that time frame, and I don't know if I'm exactly right about this, but we were in that low 4.5% range for quite a while. And 2019, we began to see rates continue to trend down a little bit, but it was a normal business for the most part. I mean, we were doing applications and numbers similar to what we had done the year before, and they were certainly good years, but not crazy. And in 2020, beginning, it was starting to look just like 19, really. And then what happened when the pandemic started? That's when really panic across the market started, and we went. I remember it like it was yesterday because I was in the process of locking a borrower in, and I had the conversation and went to lock it in, and rates had jumped up from like 3.25% to 3.75. And I called the person back, and by the time I tried to lock it back in, it was up to 4.25. And the next day it was in the 5.5% range. And in that time frame, it was like there was no liquidity in the bond market, so nobody knew where it was going to go, and we were in all out panic. We didn't know if we were going to be able to do real estate transactions. You probably remember all that.
Yeah, absolutely.
There was a lot of uncertainty, and if you in the markets, if there's a lot of uncertainty, it's not good.
Right.
So, but what started happening is, of course, the government started purchasing bonds and then started settling things down, and we slowly saw that settle down. I'd say March, April timeframe, we saw rates back into the higher threes, and then it just kept going. And
why was that? What was the reason to make that happen? Why did they keep going down?
Well, I mean, inflation was really low. I mean, all the economic data that the Fed looks for and what keeps interest rates low was moving that way. Plus the purchasing of the bonds from the government was huge, and it just that continued, and at great volumes. So that just kept rates lower and lower, and then, as they got into the mid to low twos. Yeah, and that's it was that crazy phenomenon where the home was more important during COVID. So all of a sudden, people that bought that had recently scaled down their home or buying a bigger home, and it was just that continued through 21, and we saw the market the larger due diligence requirements and all those things that we experienced, and appraisal deficits and everything that came with that. And Davis, the volume was so substantial when the rates were getting into the high twos, because it pretty much opened up even somebody that refinanced at 4% or 3.875% were refinancing again. And it was just the level of demand. It got to a point where most of the banks couldn't deliver loans in 90 days, 120 days. So companies like correspondent lenders like ourselves were able to still perform at, a 25, 30-day turnaround.
Why is that? Why does the bank take such a long time compared to you guys? What's the difference in a scenario like that?
Banks are more regulated, and there's a lot more red tape. I worked for a bank for a long time, and not being critical, it's just, I mean, more correspondent lender, that's what they do. I mean, everybody that works for a correspondent lender we're doing mortgages. So it's everybody's dedicated to that one target area.
Yeah. All right. So can you compare, you were talking about the volume. Can you compare that volume, like the 2021, your peak of 2021 to what it was in 2019, on a percentage basis or something like that? I mean, I think triple?
I think it went up 200%.
Wow.
I mean, so you can imagine what the demand for and how much mortgage companies the staffing.
Yeah.
I mean, just nobody could keep up.
Yeah.
It was crazy.
Yeah.
So, so you look back at that, and that continued through 21, and almost all the way through.
Yeah.
And so, I mean, everybody was at that point, pretty much full capacity, fully staffed and ready for this volume. And then almost overnight,
yeah,
rates went, from 2.875% in January of 2022 to 7.5% in October, November. So these companies, all of us that were, understaffed in early 2020 became, to keep up with the demand, staffed way beyond, double, tripled their staff. And so you've seen just huge companies, get out of the mortgage business, discontinue service.
Yeah.
I mean, we've had
almost a feast or a famine kind of situation.
Yeah. I mean, you can see, we've been through cycles like this, but not quite like this.
Yeah. Not this quick.
Yeah. Yeah. So it's, so now we're, the industry was faced with being overstaffed. So that's the layoff. So it's been quite the 2 years.
So when rates started to rise, I guess it was really kind of late spring, early summers when it started to have a significant impact on the market. What were some of the conversations you were having with consumers at that time, and what were they thinking versus when you're talking to a consumer in October, November? In June, rates were at 5 and they were shock, but in October they're at 7. There's probably a little more shock.
I think when it first started, it was like, I think there was this belief, especially folks that were in new construction contracts, right, that were still a ways away from closing on the home and trying to figure out what to do. And, nobody really knew. And I think there was a belief for a while as we got into the high 3s and 4% range that, it was probably going to come back down. I think that was the thought process, and I think that the market seemed to absorb that movement from 3s to 4s pretty easy.
Yeah.
I mean, it caused concern for sure. But when it got into the 5s is when, even then it seemed like, okay, when do you think rates are going to go back down, or where do you think they're going to go? And then when they got in the 6s, that's when it all, everybody got really
quiet,
really nervous. And then the 7s was, and now, now the interest rate topic is no longer, well, it's still something we talk about a lot, but it's not like it was 3-4 months ago.
Why is that? Why do you think why is that changed? Are people just getting used to it?
Yeah, I think so.
Yeah.
Yeah. Well, plus we've seen it go from its highs to now we're in the low 6s. So, I mean, that sounds high, but but compared to 7.5,
stability,
it's great. And
and
we have been telling people that what we're hearing is that rates will come back down, and there's a lot of reasons behind it. And I think a lot of the public does see that as a possibility. So I think they're a little bit less worried about it.
Can you talk about some of those reasons? A few of those reasons that you and others believe rates will come down? Yeah.
So inflation concerns have been one of the main reasons for the rates going up. I mean, interest rates follow inflation for the most part and always have. And when we had a conference in Las Vegas, and one of the companies that we listen to that predicts bonds is MBS Highway, and what they were telling us was that it was going to be a tough summer because what's the primary data for inflation is the consumer price index, and in June, July, August, and September, those figures were really, really low 1 year ago. And so economically, when the Fed looks at that, they look at from 1 year, where was it a year ago this time? And so when they look at the charts, it was going to make inflation look like it was way out of whack in the summer months. But what they told us is to hang in there. October, November, and December, it was really high a year ago. And so that has been true. So when the CPI came out in October, November, and December, it has shown that it's right around where it was the year before. So that the fear of inflation stabilized some. And I think where we're at now is that I think the Fed's still looking for the employment data. I mean, it sounds bad, but I think they're looking for layoffs. Yeah. And if that does happen, and it's recessionary, I think that typically in a recession, interest rates go down. I think we're going to start seeing, we actually saw that today. We saw jobless claims go, I think, up more than they expect. So I think there's key data to tomorrow and Friday as well.
Yeah.
So,
one of the things and I'm asking this because right before we walked in here, I saw the Fed raised a quarter rate. One of the questions, or a 0.25%, Fed fund rate.
Yeah.
One of the questions that I hear oftentimes from folks is, well, the Fed raised their rate, so mortgage rates are going up. But oftentimes it can be the inverse of that. Can you talk about that correlation and what it means and what mortgage rates actually follow?
Federal funds rate is really what is a guide for the short-term rates, like credit card rates, and the long-term rates, they tend to follow it a little bit. But a lot of times what happens is they've already, the markets have already planned for the Fed doing what the Fed's doing. Probably in this case, the markets were probably potentially expecting it to do now. Yeah. And it's priced in. So it does, the general public is surprised by that sometimes. Yeah.
All right. So I want to start as if we're a consumer, and let's put our buyer hat on, and we decide we want to go buy a house. We call you. What kind of discussion are we having from day one?
Yeah. I mean, I tend to want to, kind of get to know you a little bit, build some rapport and kind of understand what we're trying to accomplish. And find out what the major reasons for what they're trying to do. And usually through that, you can determine, what are the next questions to ask. I think it's the key is to build some sort of rapport and trust right in the beginning. And I mean, ultimately, the easiest way to go through a pre-approval process is the online loan application. But I tend to think that people want to have a conversation before they get to that. And I like to talk to folks and try to figure out what they're looking to do, and then, get to know them a little bit, and then ultimately, talk to them about the next steps. That the best way to really understand how to get a feeling for what's the best program for them, what's the best interest rate, is to really go through the pre-approval process. And a lot of folks tend to want to put that off, but really, and
why is that? Why do you think that is?
I don't know. It's a misconception to some degree. I think that some folks feel like that if they submit a loan application, that it's like the final decision's being made.
Yeah.
And it's really just a working document. It's really it's a tool for us to help them.
Right.
Guide them in regards to, if there's things that need to be tweaked to put them in a better position, to qualify or just to get a better interest rate.
Yeah.
So I mean, typically it's like a 10 or 15 minute conversation, usually, depending on how many questions. It could be a half an hour conversation, getting to know them. It's building that trust, really.
Sure.
And then, the loan application is something that they we can do over the phone. I usually offer options. Most people want to do it online.
Yeah.
And then what I tell them is, don't get it perfect. Don't worry about getting it perfect. It's a working document. And then once I receive it, I get notified electronically, and then I'll jump into your loan file. I'll look at it, review it, run credit, and then get back to you. And I usually send an email letting them know that I've received it and reviewed it, and schedule a conversation. And that conversation is really the one that's the more detailed conversation, because I go through a pretty complete summary of, letting them go through the application, make sure I don't have any questions, make sure I understand, the disposition of their home, what they're thinking as far as down payment, where the funds coming from, how's their income work, and get through that. And then I explain to them and summarize the pre-approval in that there's three main areas we look at. We look at the credit. And I always tell them what a mortgage credit report is, how it's different than a consumer credit report. Let them know their scores, and let them know that, kind of where that puts them as far as qualifying. It's different tiers. And then...
and does that have an impact? Does your credit score have an impact on your interest rate?
Yeah, it's probably the one area that most impacts your interest rate. Yeah, and then secondly, we look at assets. And really what we're trying to do is provide proof that you have the assets needed for the transaction that we're pre-approving you for. If you're looking to put 20% down, then we need to be able to provide proof that you have 20%.
That you have it.
Yeah. Yeah. So we kind of go through that. And sometimes it's, they're going to pull money from a 401k, or they have gift ideas, and go through that. And then thirdly is the income. And not to get into too much detail, but it's a simple calculation that we use. And I try to explain that to them, that it's a debt to income ratio. And
what does that mean? What is debt to income?
So debt to income is the proposed payment on the new home. So depending on the program, typically a 30-year fix is what we start with. And so that principal and interest payment based on the interest rate and the loan amount that they've chosen. To go back a step, I usually try to pre-approve people at what they see as their highest price point that they think they'd be interested in. Always feel like that's the best way to start. And then, so the principal and interest payment, and then you add the taxes and insurance and possibly an HOA and possibly mortgage insurance. So that's the proposed payment, plus any debts, like if there's student loan debt or if there's a car payment. And any of those types of debts, credit card payments, you add that, and then you take that total and you divide it into their gross monthly income. And that percentage, typically Fannie Mae, Freddie Mac, who govern most of the underwriting guidelines that we have to adhere to, or it's a 50% threshold. And so I kind of tell them where they come in at, and then I kind of go back. So, credit's great. Assets, certainly you have what you need to do what you're trying to do here. And then, depending on the debt to income ratio, I'm like, a lot of times they qualify for way more than what they're trying to do. And people like to hear that.
Yeah.
And then from there, not to go too detailed, the next steps would be to make sure we have the supporting documents, because a pre-qualification would be that process, but not really verifying the income and the assets. So we need to make sure. A lot of times our system prompts them to upload those documents, but sometimes they don't have them all. So go over that list, and then let them know that I'll send them a pre-approval letter, generic, and copy the agent on it. And from there, what I recommend that they do is, once they find, as they start their home search, and typically we're talking to them before they've actively started. Not always. Yeah. Sometimes it's buying a house today.
Yeah. The car gets before the horse.
But yeah, I tell them, look, it's always a good idea let me know, and then I can run a payment and, provide an estimate that's detailed and shows you, the numbers and the breakdown. And then if that looks good and you decide to pursue an offer, then I'll rerun it through the automated underwriting system. And once we do that, then I can update the pre-approval that's specific to that property. And I don't know if you meant for me to go that detailed, but
well, no, I mean, and then I guess next step, let's say they're pre-approved, they get that home. Oftentimes one of the things we hear is, I got to do so much paperwork. Well, A, can you talk about, is it really as much as it seems like, or is it what's necessary? And B, why is it necessary?
Well, so most of the time well, all the time, it's not a formal loan application at that point, So they haven't, we have a working document. It's a prospect file. And we've pre-approved them. But formal, once it's under contract, then the next step is to have another follow-up conversation to kind of let them know what has to happen from here. And usually there's loan disclosures that have to be sent. And that's really what formalizes loan. So I kind of go through and tell them what that's all about. And really 90% of that, Davis, is just standard boilerplate mortgage loan disclosures. They tend to increase every year. And they're mainly consumer protection. And there's a few things that are specific to them. So I kind of go through what those are. It's the loan estimate and the loan application. Yeah. And at that stage, they're just working documents. So I let them know that, hey, there might be changes need to be made, but just let us know. And there'll be a final loan application and a final loan estimate, which is the closing disclosure. The loan disclosures are can be signed electronically, so it's not really a big deal. But then that's when the processing of the loan starts. So usually up front, we've gotten a lot of the documentation, so it shouldn't be a whole lot. So the next step is to order the appraisal. And, typically we collect for that up front. So there is some, paperwork that goes with that. And then they typically fill out paperwork for the attorney too, which they kind of
put in your basket too.
Yeah. So I think there's a lot that comes at them.
Yeah.
So I always tell the referral partner, I said, look, it's real common for the consumer, the buyer, to be out there. A lot of times, especially the last 2 years, it takes, it might take 6 months to find the right home. And the buyer's when they get on their contract, their natural thing is just to go,
right.
It's rest time.
Yeah. No, it's go time.
I'm like, I need 48 hours of focus, and that typically is what it takes, 48 to 72 hours up front to sign the loan disclosures, get the appraisal order, get the title work ordered. And then from there, it's once they, we have the supporting documentation to move forward, there's not a whole lot that comes after that. They're usually, so the first thing that happens is the loan processor submits it and we receive a conditional loan approval. So it's just part of the process. So I've never seen an underwriter approve it, issue a final, I think maybe a few times, but a final approval,
first time,
based on the first look at it. So I always tell folks, look, it's part of the process and there'll be maybe a few things that we'll need. And usually it is just a couple of things. So it's that. Yeah. I usually set it up to where it's going to, look, this is not that much fun. I mean, if you set the expectation mentally that you're really, this is a little bit of a pain in the tail. And then I think and you're able to respond quickly and not, argue us about everything that we're asking for, because there's generally a reason for us asking.
Yeah.
And usually, I have that conversation and they're usually, yeah. And I say 99% of the time, you're going to think this process was easy. So I think it's a little bit about setting the expectations up front. Yeah. But I think the famous thing, or a lot of what people experience, is lenders and underwriters asking for things last minute. And that really just shouldn't happen. I mean, I'm not saying we're perfect by any stretch, but it shouldn't happen.
Yeah. So one of the things I think is important here too is, and I'm wondering if we can talk about it, but, like most correspondent lenders, as soon as you close it, it's likely leaving cross country. Is that right?
There's certainly a chance. Now we do service a large percentage of our conventional loans.
What does that mean? Can you tell us what that means?
Yeah, it's through a sub-servicer, but it still has cross country's logo on it. It's still really cross country, but it's through a sub-servicer. And it's just a third party that's helping facilitate the servicing. Yeah, collect. Exactly. I don't know behind the scenes what makes the decision on whether they sell it or keep it, but on conventional loans, I think it's like 90% that we keep.
Gotcha.
And I always go over that and there's no real difference. I mean, they're paying cross country or they're paying somebody else. Yeah.
But is that part of the reason why paperwork and the collection of documentations, it's because of what we talked about happened in 2008, but as part of that reason too is because the loan may or may not get sold post closing? Is
Yeah, I think that some of the disclosures are, it's always about saleability. So you need to have the documentation in the file. In the event the lender wants to reserve the right to transfer the service.
have the option?
Yeah. So there's certain disclosures that need to be in there for that to be possible.
Yeah.
Yeah.
One thing that I'm curious about, where does cross country get the money to lend? So I'm going to closing, they're lending me $300,000. Where's that money coming from?
Yeah, it's great. So a lot different than, well, I mean, there's really three types of mortgage company. Well, there's more than that, but the bigger banks, and then the correspondent lenders that are kind of in the middle, and then the brokers. Well, a broker doesn't use their own money. Now they have resources, a lot more resources to choose from. But a correspondent lender, also known as a mortgage bank, has warehousing lines that they use and close and fund in their own name. And bigger companies like Cross Country have multiple warehousing lines and have the funding ability through that.
And so they're just pulling off that and closing and then making the decision to service or to sell.
Exactly. Yeah. Yeah, and I'm sure on the back end there's a lot that goes into that. And I've never really been part of that.
So I'm sure technology has completely changed your business since you started 13 years ago, 14 years ago. What kind of impact has it had, and what kind of impact do you think it'll have over the next 5 years?
Yeah, I mean, I think back, this is really going to age me, but we met with all our borrowers. We actually collected
in person.
Yeah, and funny story though. The business hadn't really changed that much. There's always last minute things that go on.
Yeah.
And so this is, we were in the DC area. We were headquartered in Woodbridge, Virginia, and I think our office was in Bethesda at the time. And there's always things that happen last minute. So that's not a big deal in today's world. You just redo the package and resend it through internet, electronically. But back then it was about driving down the Woodbridge, run into the attorney. We didn't have phones. So an attorney would call you a 911 on your pager. You'd have to pull off the beltway and find a payphone. Yeah. So, I feel like the next 10 years, we're going to continue to streamline the process. I think the days of, I think they'll have e-signings mostly. I think that's going to, we have the capacity now.
Why don't we now?
Yeah, I think it's a little bit jurisdictional. I think we're really close. Yeah. I think most attorneys are getting comfortable with it, so it's not far. Yeah. We're doing hybrids all the time now. So
what's that?
So that's where I'd say 60% of the documents are sent ahead of time. Now they have to be dated the same day of closing. So what we're doing is we're giving the borrower the option to do a hybrid closing and kind of explaining that process. And most people are picking it. And we send the documents a few days ahead of time so that they can review them and then let them know you're going to get the copy to sign in your inbox at 1 a.m. And so when you wake up, just sign those. And then when you go to your closing, you're going to sign the loan application, the promissory note, the deed of trust, the closing disclosure, and the ALTA, and some of those more important documents. And the attorney will be able to go through those. But it goes from a 45-minute closing to about a 15-minute closing. And so we're doing mostly that now. It seems to be a good step to the e-signing because I think people are pretty comfortable having an attorney explain things to them.
Yeah.
And I think some people it's going to take a while for us to get away from that to some degree.
Are there any changes on the horizon technology-wise with the underwriting process or the verification? Some of the things that we talked about, that people do have some angst about sometimes. Is there anything out there that's making that easier?
Yeah, right now, most companies have authorized a third party to allow verification of employment. So we can usually get those in a matter of minutes. Now, not all companies are, allowing it, but I'd say, it's almost
And this is the employer that you're calling that allows that. Is that right?
Yeah.
Because if you're trying to call Betty Sue in HR, she doesn't answer.
That is an old, antiquated. I mean, it still has to be done in some cases, but not as often. So that has changed quite a bit. Yeah. And we still have to do a verbal verification of employment as you get closer to closing, but a lot of times we're getting verifications of employment, written verifications of employment, so we can average overtime and bonus income and commission income. But a lot of times what we're doing is so many people have the access to their pay stubs historically through like a portal, through ADP or Paycor, and we can kind of circumvent the whole verification of employment process by doing that.
Gotcha.
Because W-2 show total earnings, but the pay stub breaks it all down. Yeah.
Yeah, I think a lot of times people have that misconception that they need to have this like perfect profile coming into the gate, and I think what I'm hearing is there's a lot of things that figured out on the back end.
A lot of times by waiting, you prolong the situation, because we could have told you you don't need to do anything, or this is what you need to do. And a lot of times it's not for qualifying purposes. I mean, there's tiers for, improving your situation with interest rates. An example would be like, a conventional loan. If you have a 715 credit score, there's, that threshold of 720. Well, you're going to get a little bit better mortgage insurance rate if you're putting less than 20% down, and you're going to get a better interest rate if you get it to 720. And a lot of times that's just us telling them, hey, you can pay that credit card down $500 balance, and we can do a rescore for you and get it up, and it's going to improve your payment. And so we spend a lot of time with, and so that, just putting people in a better position. Sometimes they want to put $20,000 down payment. Well, that might be a 7% down payment. Well, it doesn't make a whole lot of sense, because mortgage insurance is based on 5% increments. It might be better to just put 5% down and run the payments, and they might be looking at making a 15 or 10% down payment, where it might make sense to pay off a $10,000 car with a $400 payment.
Yeah.
And so we're trying to, guide them.
Need to see the whole big picture first.
Yeah. And so the earlier folks do that and get ready, if there are things that need to be tweaked, we can help them with it.
Good. All right. Well, let's bring it home. I got a couple of last questions for you. One, where are we going in 2023? Where do rates, as we sit here today, we're at 6 or so, 6.25 maybe. Where are we at by the end of the year?
I think
we're going to hold you to this, by the way.
Yeah. Yeah. It's funny because I've heard so many predictions, right?
Yeah.
But my honest opinion is that we're gonna see them continue to stabilize with a downward trend. May's a big month. The inflationary data should be pretty positive for bonds, based on the charts from the previous year. I could see them by the end of the second quarter, I could see them in the high fives, 5.75%.
Nice.
And I think that's the big question.
It's not fair beyond that.
I think the big question is, will they go into the 4s?
Yeah.
And I don't really know for sure. I mean, that would be great, because I think that 4%, if it got into the 4s, I think the folks that, at some point, folks that have home that they possibly want to sell, they're thinking about moving, but they don't want to leave a 3% rate or a 2.7% rate.
They might do it at 4.
Over time, life will take over, a little bit on some of those decisions. But I think this year, if it gets into the 4s, that decision might get a little bit easier.
Yeah.
I think that's the threshold. It's hard to know for sure.
All right. So next is, I think there are a lot of thoughts and opinions on mortgage and lending, and I'm wondering what are a few things, or one thing even, that you wish people knew about your business that maybe they don't.
There's some misconceptions. I mean, I think the thing is, we're a partner, so we are working in your best interest. And sometimes I feel like folks avoid lenders big time. We're like, It's like going to the dentist.
Yeah.
You know?
Yeah.
Yeah. Well, we're here to help. And I think one thing is, what's your interest rate? Well, that's a really hard question. And I think it complicates it, Davis, because some of the credit unions and banks just, they do.
Throw it out there.
They throw rates out there. But for most correspondent lenders, it's based on so many things. There's loan level adjustments that are on credit scores, loan to value, type of property. I mean, just everything. So I can usually give a range, and I think it frustrates some folks,
Yeah.
So, but yeah, I think the misconception is we can just, what is your daily rate? Well, that's
Depends on your situation.
yeah, it really varies depending on your situation.
All right, last question. What's the most memorable thing someone has ever done for you?
Yeah, you gave me a warning on this. So personally, I don't know if there's one thing. But there's been plenty of people that I call them champions in your life. Ones that believe in you and giving your confidence through life. And of course, my parents and some of my best high school and college friends, and my minister that I grew up with was definitely one of those. And some of my childhood friends' parents, just the memories and things that build that foundation to a point where you're at today.
Yeah.
It takes a village kind of thing. And I there's not one specific thing personally. I've been blessed, with a lot of good people helping me along the way. And then business-wise, it's interesting. When I first got out of college, I worked for a kind of a land development company that kind of played the middleman between big banks and builders. Builders trying to get acquisition, development, construction financing. And in the late 80s, early 90s, the S&L crisis occurred. So a lot of that whole, real estate just shut down. Builders weren't, so I got into the mortgage business kind of out of default, really. And it allowed me to call on home builders and ended up working. And I would say I was 26, 27, and I was fairly new. I mean, really new and green in the mortgage business. And I had a guy that he was president of the bank and ran the mortgage company, and he believed in me. He made me a manager at 26, 27. That's all changed my life.
Yeah.
Yeah. Yeah.
Awesome.
Yeah. And it was, I don't know if everybody in the organization agreed with the decision.
Yeah. It was his decision.
But he was right.
Yeah. 100%. Well, that's awesome. Well, this has been awesome, Davis. I appreciate
Thank you
it.
for the opportunity.
Yeah, thank you.
It's great.
Yeah, appreciate it.
I know. Well,
Good, Chris?
Yeah,
was it okay?
I had.